Why do you think that the worst might be over in the fourth quarter?
Hi, good morning, David. Yes, as you said, we think the worst is over for the Chinese banks, and we are probably in the beginning of a multi-year fundamental turning point for Chinese banks at the moment. I think with the credit demand growing and PBOC hinting a lot of marginal tightening, it is very likely that loan pricing power will improve. And also more recently, you see the crackdowns on internet finance, cross-region deposit taking, etc. So NIM will be bottomed out. And also on asset quality front, fourth quarter last year is very likely to be the worst quarter, and we are expecting sequential improvements in asset quality as the economy rebounds. Over a longer term, Chinese banks are already seeing some results in their digital transformation in terms of customer acquisition and own efficiency. And last but not least, dividend is still attractive, and we are expecting progressive DPS for Chinese banks in a very stable manner. So overall, looking at this set of fundamentals, we think it is very likely that we're at the beginning of a turning point, and Chinese banks will kick off a new round of growth from 2021 onward.
Yeah, multi-year fundamental turning point is what they're calling it. Can you talk us through a little bit more on the dividend play? Because I was a bit surprised when I looked at numbers. You are getting a lot of dividend yield in China, also compared to what you're getting outside. Is this for real? I mean, are Chinese banks really dividend plays? Would you recommend that for that theme?
Yes, I do. Dividend has been a very strong thesis for investing in Chinese banks. The thing is, for major state-owned Chinese banks, they are paying 30% dividend now, and we think this is sustainable, and probably there are some even upside to this dividend, given the very strong demand from their biggest shareholder, which is MOF. And I do understand that a lot of Western investors concerned, do they have the capability to pay this dividend in a sustainable manner? And my answer is yes, they do, because the thing is, look, this sector is still a largely very controlled sector. We talked about NIM contraction for a lot of years, and now NIM has rebounded as the quality has stabilized. So largely this like single-digit earnings growth is kind of guaranteed under the current regulatory framework. And with the economy growing, well, banks thrive in the when economy grows. So yes, I think 6% dividend is sustainable, and yes, it is a very attractive yield for the investors.
Indeed, and certainly by comparison with its Western peers, or with their Western peers. Leon, exactly. What is happening in terms of asset quality at these banks? Where are we in terms of bad loans on the books of these banks?
Yeah, well, in fact, last year in the first quarter when COVID happened, China got a hit, especially in the SME segment. And we are seeing NPLs, overdue loans, spiking in first quarter and first half last year. But as China controls the pandemic in a very rapid manner, and as the economy gradually recovers, the SOE cash flows has been improving. And the other factor is that so-called Chinese banks so-called sacrificed 1.5 trillion profits for the real economy, largely the SME segment last year. We know all the negative sides. They sacrificed the profit, but there's also a positive side. The SME cash flows improved very rapidly, and delinquency decreased. But from an accounting perspective, there is a loan seasoning process. That's why it takes between 6 to 9 months for the between the improvement of cash flow of SMEs and the improvement of NPLs being recognized on the books of Chinese banks. And the other thing is, how are they provisioned against the potential NPLs? The thing is that last year, you see the provision coverage ratio of Chinese banks all spiked a lot. In particular, we have, for example, China Merchants Bank at over 450 times provision coverage ratio. So $1 NPL, you have $4.5 covering that potential loss. That's why even there are some questions into the reported NPL number. I think Chinese banks are well provisioned, are well buffered against any potential rises in NPLs. So asset quality have troughed, in my view.
Okay, Leon, when we speak to investors that are not keen yet on taking a position in Chinese banks, they often cite the risk that the government will step in and direct these banks towards policy priorities rather than the business priorities that the banks may otherwise be focused on. How do you look through that as a risk?
Yeah, that's an interesting point. Yeah, that has been one of the key questions over the past decade, I guess. Yes, Chinese government do step in from time to time. But the thing is, as analysts, we try to anticipate the policy focus of the government, whether it will be good for banks or whether it will be bad for banks. Last year, obviously, it was a negative. But for the time being, let's say for the next 2 to 3 years, the thing is the financial regulators' priority is trying to eliminate the so-called regulatory arbitrage. We see crackdown on and financial crackdown on P2P, and going forward, there are higher requirements on all the financial businesses have to have license. So in fact, eliminating the regulatory arbitrage in financial sectors is a positive for the licensed financial institutions, namely the biggest ones being Chinese banks. So the focus on policy is gradually shifting from making banks to support the economy into cracking down some of the gray areas that is competing with Chinese banks. So actually, I think it is not a negative at the moment. Yeah.
Yeah, Leon, just to take that question of Tom a step further, I mean, it's going to be very hard to convince someone to take a portion of their long-term portfolio and put them in Chinese banks if you are sort of picking between that and, say, other faster-growing parts of the market, like tech and internet, for example. Within the banking space, though, you make a very good point, and I was hoping to ask you about China Merchants Bank, because you can tell us what's happening with China Merchants Bank. That's one of your top picks, and I look at what's happened in that market. Why is the market so in love with that stock?
Yeah, the China Merchants Bank is being so loved by investors. But the thing is, first of all, China Merchants Bank checks all the boxes that we just mentioned. And in addition to that, China Merchants Bank has perfectly showcased that how a traditional financial institution utilizes technology in transforming its business model. If I ask you what is the most important KPI for China Merchants Bank, you probably won't guess it is MAU actually. MAU is the most important business metric for a Chinese bank. And indeed, from giving its efforts made in customer acquisition and also digitalization of its whole back office process, you see on front office, customer acquisition cost, it is the lowest, customer experience is the best. On the back office, efficiency is the highest. And also, China Merchants Bank's management is very market-oriented. They do have the ability to articulate its strengths to the investor base, so that investor base understands it better. I think overseas investors are being more and more selective on a traditional sector like banks. That's why the banks who can demonstrate some differentiation, especially taking a very open attitude towards new technologies, will be loved. And it will be loved by the overseas investors, and the company has demonstrated very good execution in that front to secure the confidence of long-term investors.